Perhaps you've heard the phrase evidence-based investing and wondered what it means. Perhaps you've read about it and wondered how you can actually invest in an evidence-based way. Well, this episode is especially designed for you because it's all about evidence-based solutions for UK investors. I'll be talking to two EBI practitioners, Laurentius van den Vorm, Head of Investment Strategy at Timeline, and his colleague James Gillespie, an investment solutions strategist. Between us, we'll be explaining what we mean by EBI, whether you need to use a financial advisor, and what the best options are. No, we won't just talk about Timeline, and I can promise you we'll avoid unnecessary jargon. So let's get started. I think you're going to find this very useful. Guys, I think we should start with a definition here. Laurentius, what do we mean by evidence-based investing?
Yeah, Robin, that's actually a very interesting question because you would assume everybody has evidence for their investment approach. When we talk about evidence-based investing, it's actually a very specific concept, and it's basically the concept of making investment decisions on the last 100 years, as long as you can get, let's say, at decades of academic research, historical market data, and basically just looking at where in the market have we seen specific characteristics that have proven to actually give investors a decent return, and then just tilt your portfolio towards those, we call it risk factors or premiums. But actually it starts at a much more basic concept. It starts with what does evidence suggest that actually works? And we know being diversified, low cost, starting with a broad-based index, we can see that as an evidence-based approach as well because we know that has worked. We've seen the evidence that low-cost index funds actually has provided top-tier performance. And then once you've got that basic market in your portfolio, you can then tilt your portfolio towards these characteristics that should outperform over the long term. And that's in essence the concept of evidence-based investing.
That approach seems eminently sensible. Some people listening to you talk there might be wondering, well, why don't all investment professionals invest this way?
Yeah, it's interesting, and you would assume everybody has evidence for their investment approach. I would say most of the times people don't always have evidence for their approach. Their approach might be based on, well, theory. There are a lot of theories out there of what will happen over the next coming weeks, coming months, coming years. And essentially what a lot of investors are doing is they are investing in what the crystal ball is telling them to do. And it's the hard reality, and everybody doesn't focus on what the markets have actually told us in the past could happen.
James Gillespie, now you work here at Timeline in a slightly different capacity now, but your background is in investment management. What we're talking broadly about here is passive investing, isn't it?
Yes.
And of course, passive investing is a very broad church. I think on its simplest level, people will know about index funds. Maybe you could just briefly explain what index funds actually are.
Yeah, absolutely, Robin. So index funds they do what they say on the tin. So the fund is just the vehicle that the securities lie in. And in an index fund's case, it's the index that is the investable market. So the best example would be to take everybody's favorite FTSE 100, which is the UK's largest 100 publicly traded companies. And the index simply tracks those 100 companies as they move through in and out of the market. The fund itself just tracks that exact same investable universe. When a fund drops out of the index, the fund trades out of the fund. And so index funds are simply just vehicles for investors to track indexes over time.
And they're market cap weighted generally, aren't they? So briefly explain what that means.
Yeah, so it just refers to how each security is weighted within that index. And market cap is short for its market capitalization. So if you imagine something like an equal weighted fund, if we take Apple, Microsoft, and Tesla, an equal weighted fund would say that we invest equally in 33.3% in each of those securities. That would be an equal weighted fund, or index. In a market cap weighted index, we weight them by their own market capitalization or how large they are in their own index. So we know that Apple may be larger than Microsoft, which may be larger than Tesla. And so depending on their size in their own market is how we then weight that index. So more successful companies receive a higher allocation, versus the smaller companies receiving smaller allocation depend on their market cap.
So you've explained traditional index funds, but there's another kind of fund, isn't there? And Laurentius was hinting at this earlier, that is broadly passive, but has what we might call an active tilt. Now, these funds have different names: alternative beta, strategic beta, smart beta. Beta is normally in there somewhere.
So-called dumb beta, that phrase as well.
Maybe you could explain what alpha and beta actually is, apart from two ancient Greek letters.
Yeah, I think the industry does a really bad job with terminology, Robin. We make it very difficult for the average Joe to understand investments, and this is a key example. If we strip it back, alpha and beta is just simply the terminology used to describe returns generated by a market. So if we go back to my FTSE 100 example, perfect beta would be the returns attributed to the market itself, the FTSE 100. And then alpha is just used to describe anything that outperforms that benchmark. And another way to think about that is anything that's unexplained from market returns. A key example of that would be manager outperformance, for example, where they've selected different overweights and underweights on that market that they feel will underperform and outperform. And if they get that right and create alpha, then we would attribute that to, say, manager skill or potentially manager luck. So that's alpha and beta. So smart beta is where you would take segments of the market, different styles, sizes, and you would overweight to those specific parts of the beta. And the best way to describe this is our friends at Dimensional do a great metaphor here, which is to think about an ice cube tray. So if we think about the FTSE 100 as an ice cube tray sitting flat on a table, that ice cube tray can be split into, if you think about it as the companies in the index, it can be split into size, can be split into style, being cheap or expensive securities, or potentially profitability, how profitable securities can be. And smart beta, if you like, or factor investing would take that ice cube tray and simply tilt it so that the water would run into different segments of the market they feel academics have proved to outperform. And then once frozen, you would own more of those tilted assets and less of the ones they don't feel the academic support over time. And simply smart beta is the overall term used for different parts of that overweighting.
I love that ice cube tray analogy. Laurentius, factors. There are, in fact, lots and lots of factors, aren't there? I understand there are more than 400.
Yeah, correct.
It's been described as a zoo of factors, in fact. But there are a few key ones that we need to focus on. What are they?
Yeah, I think your flagship factors, it all started actually by what James just explained to be beta, the market. What is the risk that we actually take in our portfolios relative to the market? So the market should be a factor. But then when it comes to factor investing or evidence-based investing, you're looking at your flagship factors, and that would be your size. Your smaller cap companies should outperform larger cap companies over time. Looking at the value factors, just saying companies that are relatively cheaper than your more expensive companies should mean revert and outperform. Looking at profitability, that's what I like to call it the common sense factor. Companies that are profitable should outperform companies that are not profitable. Then there's a wider range of other factors you can think of: momentum, low volatility, high dividend yield, and then I can actually extend that to, well, hundreds and hundreds of factors. And I think that's the key factors that we would probably be focused on is your size, your value, your profitability factors out there.
Of course, there are no guarantees in investing, of course. But the long-term evidence suggests that these factors should produce outperformance over the very long term. It must be said, recently, and by recently I mean in the last few years, these factors haven't actually delivered the kinds of premia that we were expecting or that we might expect from them. Explain that.
Yeah, it's always a frequent question that comes up. Let's take value and size, small cap stocks. They have actually underperformed over the last 10 years. Does that mean the factor is not that relevant or that aggressive or that robust anymore? And to answer that question, you need to take a long-term perspective, not just will it come back, but have we actually seen this level of underperformance in the past? And you can actually look at, especially in the US, you can look at data since the 1920s, even longer back, but since the 1920s, we've got very, very solid data sets. And what we've actually seen is that you should expect periods of 10 years, even longer, of underperformance in your factors. It's called a risk factor for a reason. It's more risky because the asset is a bit more volatile, but it also goes through periods of underperformance. The value premium has now been out of favor. The size premium has also been out of favor for a bit longer. The value premium has actually come back over the last 3 years. It has actually outperformed growth stocks, but we are still waiting for the smaller companies to still make a comeback. Something like your profitability premium has been pretty persistent and pretty defensive over the last 10 years. So taking a longer perspective, nothing is unprecedented. We've been here before. We should expect 10-year rolling periods of underperformance, and that's essentially where we are.
So people might be listening to this and thinking, there's an option here to invest in index funds, invest in the whole market very cheaply. That might, to some, appear a very appealing proposition. Why should they take the extra risk of tilting to these factors and possibly underperforming in the future? And of course, it must be said, these strategic beta and smart beta funds, call them what you will, they are more expensive than traditional index funds. Is it worth it?
Yeah, it's true. I think let's start with the benefits of a traditional index fund. It's cheap. You can get an index fund for less than 10 basis points. You've got relative predictability. If the market is down 20%, you're going to be down 20%, and we know how the market recovers. So you're going to recover alongside the market. As soon as you tilt your portfolio towards these factors, you don't have that predictability. It is more expensive. You can go through periods of underperformance, but actually what you are buying into is you are buying into the higher expected returns. We do expect these returns to be higher in the future. It's not higher by a few basis points. It's actually pretty significant. To give you an example of small cap stocks, for example, if you take £1 invested over the last 100 years, the global markets would have reached about £14,500. £1 in small cap stocks would have reached about £270,000. So that's a significant, it's a 100-year investment horizon now, so it's just illustrative. You're not going to get that level of returns in any reasonable investment horizon, but it shows you how aggressive these size premiums can be. The value premium probably a bit less aggressive, but also less risky, but significantly outperforming just the normal market if you look at the historical context. And that's what we are trying to buy. We are trying to buy additional performance incremental to what the market is already going to give us, but at an additional risk.
So as with all investing, you need to be patient, you need to be disciplined and not give up just because a premium hasn't shown up for maybe 10, 15 years.
Exactly, and for as long as this premium doesn't show up and other stocks become more expensive, let's take the value and growth premium. So value stocks are your stocks that are relatively cheap, growth stocks are your stocks that are overpriced. Theory should tell you that over time, your value stocks, if they are great companies, they should mean revert to fair valuation, and your companies that are overpriced, that are too expensive, should also mean revert to fair valuation. So where do you want to be? You want to be in your stocks that are going to mean revert upwards. A great company that is cheap can't be cheap forever. And a company that's expensive can't go indefinitely more expensive because at some point nobody would be able to actually afford it. So actually, eventually, it's not just based in historical market data, it is also based in theory and in academic literature.
So James, we've talked almost exclusively so far about equities, shares, stocks. But people, of course, shouldn't just be investing in stocks. What other sorts of asset classes should they be considering?
Yeah, absolutely. I think equities are probably the most important asset class for every investor. But I think what we've not talked about today is fixed income. I think that's obvious. Everybody has a risk appetite, Robin. So we talked today about severe underperformance over time, market volatility. And the way that we can dampen that is through good quality fixed income. So by blending fixed income and equity, maybe it's 50-50, 60-40, 70-30, you can then create a portfolio that generates substantial returns, but perhaps dampens off that underperformance that's in line with a client's risk profile or potentially in line with their capacity for loss. So we have to think about blending equities and fixed income for the average investor, for them to feel comfortable investing for that long term, making it easier for them to generate wealth. And no good investor is an uncomfortable investor. And for us, fixed income is a way to help that.
And as with stocks, you've got different shades of fixed income. For example, you have government bonds, you have corporate bonds and so on. I mean, again, what are the main assets people need to be thinking about?
Yeah, again, just like equities, you want to be diversified. So owning one part of the fixed income market is not going to defend you. You want to, we've seen through, our historical data that Laurentius mentioned, we see several market downturns that can be attributed to different factors. What's interesting is no single part of the fixed income market is predictable enough to defend every downturn. So if you were in government bonds for the last 100 years, it wouldn't have defended you in every single downturn. If you were in corporate bonds, the same would apply. So you want to be diversified across that fixed income spectrum so that you can benefit from its defensive nature. So at Timeline, we like to hold good quality bonds. So anything that we would attribute to BBB and higher. We want to own slightly shorter duration in bonds so that there's not as much interest rate sensitivity. And we want to own globally diversified fixed income because just like equities, there's geographical risk associated with that.
And just to clarify, because I think this is a point many investors don't fully understand, you can take an index approach to fixed income as well as stocks. And in fact, what the evidence shows is that over time, that index approach to bonds has proved just as advantageous in bonds as it has in equities.
Yes, absolutely. I think fixed income has indexes just like equities, and actually we find that the fixed income market is slightly more predictable than equities. So those indexes are just as easy to track, and actually they can be cheaper to track given the sample size that you need to invest in order to track that relative index. So yes.
Different assets fall in and out of favour all the time. A really popular asset, as you know, here in the UK, I'm sure it's the same in South Africa too, Laurentius, a very popular asset has been buy-to-let property. It's not quite such that the hot investment that it used to be. What should people be thinking about if they're considering buy-to-let property?
Yeah, it's a really interesting one and one that gets debated a lot. I think we're very used to that low rate environment that we've had for a very long period of time up until COVID. And with low rates comes low mortgage rates, and the access to property was far easier. So people were able to take out mortgages for those buy-to-let properties. But now that we're in a much higher rate environment, nearly double of some, potentially triple where we were, the access to that is now restricted. So it's far harder to get those buy-to-let mortgages, and the access to that investment is now restricted. Secondly, house prices in general have risen massively over the last 20, 30 years. And therefore the actual investment itself is now completely different given the asset price. And then finally, Laurentius and I were just chatting about the tax implications of buy-to-let. The UK government regime does not make buy-to-let as attractive as it was 20, 30 years ago. And you need to be considerate to the fact that it's income tax versus capital gains tax and what that means. And we're going to come to this shortly, but financial advisors are very good at guiding that journey, because you can have a great investment strategy, but it needs to be tax efficient. And unfortunately, buy-to-let has just become less attractive in that space over the last short while.
Laurentius, every time I pick up the Financial Times or an investment magazine these days, I'll read about private equity, investing in private companies or moving public companies over to sort of private markets, investing in them, trying to increase their value with eventually the goal of selling them at a profit. It sounds a great idea. Yeah. Is it a good idea for most investors?
Well, Robin, it's definitely a fascinating asset class. Personally, do I like private equity? Absolutely. Do I think for your average investor, your mainstream investor, let's call it your retail investor, it's a suitable asset class? I would strongly suggest that it isn't. I think if you think of private equity, there's basically four things that comes to mind. One is high barriers to entry. You usually need in the hundreds, if not millions of pounds to meaningfully invest in private equity. Two, you've got high illiquidity. Your asset takes about 3 to 5 years to fully invest. Once you are invested, you are locked in for another 7 to 10 years. So you don't have that liquidity. You cannot actually just sell out of your funds when you need the cash. 3, once you're locked in, then they are taking extremely high fees on your private equity. They usually refer to the 220 fee structure. What that means is you are paying 2% annually on your private equity funds. Now remember, on public equities, we are referring to any fund more than 0.5% as expensive. This is 2% per annum. There's usually a 2% upfront charge as well. And then the 20 means 20% of your performance are being paid as a fee to them as well. So just to be on par with the global equity market, they have to outperform the equity market significantly. So for a normal retail investor, I don't think that's a suitable investment. And then the fourth one, I would say high risk. You can actually lose everything. Private equity companies are very often investing in companies that are not established. Think of your venture capital companies. You do have the risk of losing everything. So you first have to identify the risk, the cost, the period of illiquidity, and then the barriers to entry. And just because of those 4 factors, I would say it's not as attractive.
Talking about investments where you can potentially lose everything, if we could move on to cryptocurrencies. I think we all know or have heard of people who actually made a fortune on, or a small fortune at least, on Bitcoin, for example. Is it a sensible investment, or indeed, is it an investment at all?
Well, Robin, if you look at Bitcoin, your most famous cryptocurrency, it's currently trading at just shy of $60,000. Over the last 8 years, Bitcoin has returned about 13,000%. It's an incredible asset class. Well, you have to be conscious of the risk that you are taking. Looking at the drawdowns that you have seen in Bitcoin specifically, looking at back at was it 2017, 2018, Bitcoin has crashed 85%. Since that, I think it was in 2022, we've seen a drawdown of 75%. So unless you are willing to lose everything, or looking at the history, at least 85% of your money, don't go there. It's not a safe asset class. It's not something that you can bet your retirement on, but it has done significantly, performed very well over the last 8 years.
So, James, as we discussed, most investors primarily should be invested in equities. As you mentioned earlier, they will almost certainly, depending on their age, want an element of bonds as well to dampen the risk that they're taking. And the best way to go about it broadly is through passive or essentially passive style funds. Now, a very popular type of fund that we hear about these days is the ETF. Maybe you could explain briefly what an ETF is, and are they the way to go?
Yeah, sure. I think we have to be careful. The industry creates products for product's sake, and I think we've seen that through the several vehicles that have been released just for the sake of something being new or changing one small thing to sell something else. ETFs are simply the same investment as a fund, except the vehicle is different. So with a fund, you're buying a unit of a fund. So you own that fund, you don't own the underlying securities. And so that fund settlement time can be 2 or 3 days. An ETF or an exchange-traded fund is traded on the exchange. So what that means is when you give the ETF the capital, it goes directly into the underlying securities and thus is traded on the market. And it was actually created in the US because there was really, really attractive tax benefits to that only work on the US tax system. So the benefit there was quicker investments. You can turn it out in minutes, just like you can a security, but also an overarching ability to tax plan with your ETFs. In the UK, that doesn't apply. There isn't the same tax benefits, but it is attractive for those who are looking to buy and sell in a much quicker pace. Funds, as I said, 2 or 3 days. But if we're talking about what we are, which is long-term passive investments, there isn't a need for that ETF structure because we're in it for years, never mind needing to trade in hours. And so when we look at the layered cost of that, is it worth it? Now, ETFs are as cost conscious as funds, so there isn't much in terms of actual ongoing cost, but what you need to be careful of is the dealing charges that you get on retail platforms for the difference between a fund and a ETF. ETFs are treated like a security, so you will incur a dealing charge. I was looking just before I came on at this, and actually you find that on the current retail platform I use, it costs me 4 times as much to buy an ETF as it does a fund in terms of dealing charge. and actually I'm buying the same thing, but I just don't need to trade it as fast. So I would just be wary of it in terms of, do you actually need an ETF if you can get a same low-cost alternative in the fund structure? But it does have its benefits for more active style fund management that needs to trade in and out on a quicker basis.
I find another misconception about ETFs is people assume that they're passively managed. I mean, generally they are cheap, but they are very often actively managed, and obviously the active ones are more expensive. And there are all sorts of different active strategies that you can pursue with ETFs, but that doesn't necessarily mean it's a good idea to do so.
No, absolutely not. I mean, I was just looking at some stats this morning. So in Europe, if we take the European 350 as our European benchmark, over the last 10 years, only 8% of funds have actually managed to outperform that European 350 index. And if you just coming back to your point on ETFs, it's the attractiveness of the ETF. It's just a vehicle. So you can do the exact same thing as underlying. You can do the exact same thing in a fund as you can as an ETF. You can be an active ETF or a passive ETF, be an active funder, but it doesn't take away from the fact that at the moment, active funds over the long term are struggling to keep up with benchmarks.
So, Laurentius, ETFs, as we've heard, are very popular, particularly with people who like to trade, who like to buy and sell. But again, the evidence shows that the more trading you do, the more buying and selling you do, generally speaking, the worse it is for your returns.
Yeah, and I think it all comes down to, we've all heard the saying, it's not about timing the market, it's about time in the market. And I think the evidence are quite clear. If you are trying to time the market, at some point you're going to burn your fingers. On top of what James just said about the ETFs, one of the negativities to all the costs is the trading cost. Not just the amount of trading, but let's say you invest in an active ETF that all of a sudden becomes illiquid. Now you've got a bid-ask spread on the exchange, and you have to pay that spread as well. So you don't have a consistent higher charge. It actually varies over time. You might want to sell out when everybody wants to sell out. Then you're going to pay for it. We've all seen the evidence. Sticking to your guns, staying disciplined, buying a low-cost, broadly diversified asset, and keep that asset for as long as you can throughout your market cycles. That should give you the best outcome at the end of the day.
Now, James, as I hinted earlier, you moved away a little bit from investment management. You are now working more with advice firms and helping advice firms on their propositions. And that leads me to my next question. What about financial advice? Should people be using financial advisors? Do they need to? Is this something they can do on their own? What are your thoughts on that?
Yeah, it's a great question. So I think I'm actually going to come back to one of Laurentius' points is earlier, where we were just talking about this idea in private equity. We were talking about this idea as an ordinary investor, which I think is really important, because at the moment we think about the ordinary investor as quite a high net worth, complex individual who needs investments, needs tax planning. And so if you're defining the ordinary investor as that, then financial advice is absolutely the way to go. I think we've over time will absolutely pay for itself and more. And also it provides a layer of emotional support that I think is underplayed. We can all pick a great investment strategy. We can invest in it long term, but if we hit a point in time where markets hit a downturn, markets become extremely volatile, there's a risk there that we sell. And if you sell and buy at the wrong point, doesn't matter what your investment strategy is, it's gonna impact returns. And so having a financial coach or financial advisor there, talking you through it, educating you, keeping you level-headed through those periods, is absolutely invaluable. On top of all the legacy tax that we talk about. So for the ordinary investor, I would say absolutely. But I will caveat that it should not be a restriction it shouldn't be a necessity for every investor. So, people out there thinking about starting to get involved in investing do not need a financial advisor. Whether it be a small ISA, a small general account, get started. And as your situation becomes potentially more complex, then there's a right time and a right moment for you to get a financial advisor involved. And that's the critical point.
I think as well, people actually quite like the challenge of sorting it out for themselves. I'm not necessarily saying that's a good thing. It really all depends on the individual. But let's say somebody has thought about all of these issues carefully, and they think, right, yeah, on balance, I think I can do it myself. I've got time. I've got, the inclination to do it myself. What are the options for UK investors who want to go down the DIY route, if you like?
Yeah, absolutely. We're blessed with the age of apps and technology. There's lots of good retail platforms now that lend themselves to your mobile. AG Value Invest, Interactive Investor, all have very competitive charging structures depending on what you're trying to invest in, and you can get set up in literally minutes. Once set up, there is a range of very competitive, low-cost, diversified funds that we've talked about. Vanguard Life Strategy being a standout of those, which I'm sure Laurentius can talk a bit more on. But also there's others, HSBC Global. You're looking for global diversification, a low amounts of active management, and low cost.
So we've heard James mention Vanguard Life Strategy there. Full transparency, I myself invest with Vanguard Life Strategy. Well, what are your views on them?
I think, Robin, it's a great strategy to invest in. It's filled with low-cost, broadly diversified index funds. You can choose your equity bond split according to your risk preference. We often compare the Vanguard Life Strategy sort of as a general benchmark in the market. Were you able to live up to the Vanguard Life Strategy? We do a multi-asset fund report, a timeline once a year, and the Vanguard Life Strategy has consistently been in the top 3 multi-asset funds in the UK. You get that for 22 or 25 basis points. So great cost structure, great performance. There are, if you compare it just to the general market, there are small discrepancies that have caused them to slightly underperform, and I'm using the word underperforming very lightheartedly because still top tier performance. But for example, they have sort of tilted their portfolio towards what UK investors find familiar. We call it the behavioral bias. You invest more in your home market, so they do have a UK home bias in their portfolio. That didn't turn out in their favor really very well over the last couple of years. On the fixed income side, they were slightly long on duration. Duration just means higher interest rate sensitivity. Given the high rates at the moment, that didn't turn out very well for them on the fixed income side. So there's a slight element of underperformance from those two, call it carve-outs on the life strategy. But other than that, a great multi-asset fund.
So you can invest in Life Strategy as a DIY investor, or you can actually do it through a financial advisor. But there are investment solutions, aren't there, which you can only access via a financial advisor. And some of these, including Timeline, are very, very good indeed. Tell me about those.
Yeah, so I think, first of all, let's start with Timeline. Timeline is creating model portfolio services or model portfolios for advisors. The way we do it, basically, we aggregate advisor money and we sort of act as an institutional investor, trying to give retail investors the same access as your large institutional houses. So comparing Vanguard Life Strat, 22 basis points, which is fairly competitive out there. Well, I wouldn't say fairly competitive, it's very competitive, to our Timeline tracker, which is doing a very similar investment strategy. We can design our Timeline tracker for 8 basis points. Our fees are 9, so you're looking at 17 basis points. So financial advisors now have the option to give their clients a very, very cost-efficient investment vehicle. And then some fund managers thinking of Dimensional. Dimensional fund advisors are only available through financial advisors. Dimensional is your typical fund manager that will lean into these risk factors, lean into smaller companies, lean into profitability, lean into value securities. And it just gives you a broader range of options when you go through a financial advisor.
Now, there is this perception, isn't there, that indexing or broadly passive investing is settling for average. But I've seen several surveys actually in the last few months which actually show that low-cost evidence-based solutions like Timeline are actually amongst the top performers. In fact, there was one de facto study, I think for the 3-year period to the end of May 2024. Now, normally over such short periods, you'd expect active managers to be right up there at the top of the table, and for the passive ones to be maybe nearer to the middle, if you like, or at least second quartile. But Timeline was the very best performer of all. And in fact, the top 10, 9 of those were low-cost, broadly passive strategies.
Must be a phenomenal investment team. No, I think, Robin, when you think about the way passive funds work, what are we doing? We are buying the collective of the global market. So essentially, we are investing in the collective wisdom of the market. And it's an age-old theory by, I think the guy was called William Sharp, that said, on average, it should be a zero-sum game. For every winner, there must be a loser. When you buy an asset that goes up, somebody must have been selling that asset. So on average, it must be a zero-sum game. We know passive funds are much cheaper than active funds. So on average, it must be a negative-sum game for your active managers. Now, that said, you probably do find your skilled active managers that do tend to outperform from time to time. But still, if you invest in the collective wisdom of the market, at least over a 1-year period, you're going to be sort of on average. Whether the evidence doesn't suggest that, the evidence suggests over a 1-year period you are still in the top quartile, but let's say you're on average. Next year, you're going to be average again, and people in the first quartile or the first half are going to drop out, or some of them are definitely going to drop out. That's going to move you up in ranks. And that's normally why we see your passive indices, for probably anything longer than 3 years, you should expect passive investments that are truly passive in the sense they are not making any tactical decisions. They should be in the top quartile. We actually expect them, if you look at the research, and you can look at S&P, Morningstar, Vanguard research, they all tend to show that over a longer time periods, 5-year plus, 10 years plus, you should be top decile, meaning in the top 10% of all funds in the universe. So that's a great position to be in.
As Laurentius says, James, the SPIVA analysis from S&P Dow Jones, the Morningstar Active Passive Barometer, they all basically point to the same thing, that most active funds underperform for most of the time. But these surveys we've seen and Timeline coming top over just 3 years, 9 of the top 10 being passive. These are extraordinary results. Is there something about the market environment now? I mean, we're always hearing excuses from active managers, and what I hear regularly is the so-called Magnificent Seven, who've dominated the S&P 500 in America. Is that a factor, do you think?
Yeah, I think listen, it's important to define, active management plays a very critical role in our investment systems and our financial markets. And in the context of what we're talking about, long-term solutions for investors, yes, they have underperformed. But I think it's been an extremely difficult time, as you mentioned. You talk about competing factors in the market. You've got geopolitical tensions pretty much globally now. You've got economic headwind from COVID. You've got central bank fluctuations. You've got geopolitics playing a part. And I think what's happening is that undercurrent is swelling and is making the markets really unpredictable. We've seen several markets decline and recover very quickly, and that's always a telltale time that they're sensitive. We've also seen markets some markets be extremely resilient in times where we thought they could come under severe pressure. I think there's been the idea of a looming recession now for pretty much 3 or 4 years. And so you've got active managers have more room to play because there's bigger uncertainties, and they like that. More uncertainty is more opportunity, but with that comes more risk. And if it only gets for them to get caught on the wrong side of a couple of decisions, and then they have to play catch up to the index, and they lag the index. And then they start having to try and recover that position, and it can slowly become quite difficult.
Laurentius, we've talked about the benefits of using a financial advisor, but it's important, isn't it, to choose the right financial advisor. We've got a lot of consolidation that's been going on in the UK advice space. Big firms with their own investment propositions, very often their own platforms, offering their own actively managed solutions, which are generally more expensive than solutions like Timeline. Explain why this might be good for those firms, those big consolidators and their private equity backers, but actually not very good for clients in those firms.
Yeah, I think I can think of two rationales why you would want to sort of vertically integrate, own all the levels of the supply chain. The one reason would be to just have an efficient system. Now, do we see that in the industry very often? I don't think so. I think more often we see the second reason why people want to vertically integrate, and that's to sort of grab a bit of the commercial buy, add some fees to their own pockets in every piece of the supply chain. Can they vertically integrate and still work in the interest of the end client? It's possible. You can have an efficient platform, an efficient, let's say, your own tech stack, and invest in a very cost-efficient, broadly diversified investment solution. Nothing wrong with that. But at the end of the day, I think your independence or just showing independency is quite a crucial thing that advisors or end clients should be on the lookout for. If you're looking for an advisor, are they giving you a low-cost, broadly diversified investment solution that's not too expensive? Have they got the historical data to actually prove that that's how they are going to invest? So that's something that I would say is pretty important. And at the end of the day, fees probably is the big thing why they would not want to be independent.
Yeah, about 10 years ago, your boss, Abraham Marcusnair, and I were almost voices in the wilderness talking about the benefits of passive investing. Thankfully now more and more advisors in the UK are moving in that direction, but there are still many firms that are holding out and that have active strategies, some that take very high risk and some that are very expensive as well. What are the red flags, do you think, that people should be looking out for when they're interviewing a potential financial advisor?
I think, back to my point, are they independent? They can be part of a wider firm, which can be a great firm, but are they actually independent in trying to find the best outcome for the client? That should be the first thing. Cost plays a crucial role, not just the advice fee, but the investment fee, the platform fee. You're paying so many fees. Transparency, are you actually showing me what I'm going to pay? I think if you look at those three things, independency, are they working in the interest of the client, are they actually trying to do good, and are they transparent, then I think that's sort of a good starting point.
Both of you guys are extremely savvy about investing in the financial markets. James, would you use an advisor yourself, and what would you recommend to people who are trying to choose a suitable advisor?
Yeah, absolutely. You have to be aware of your own blind spots, Robin. So a financial advisor is absolutely, regardless of how savvy you are with investments, they provide a much more holistic role. And so, even for Laurentius and I who work in investments, they're still very useful for picking up blind spots that you would have natural biases towards, and providing a holistic planning approach to your tax legacy. So yeah, and I would just reiterate Laurentius's point, to stay away from product pushers. I think that's the big message there. Anything that's tied to an incentive is not independent. So it's really important for us that's the case.
And a key point to remember is that advisors don't just advise on investments. Exactly. There's lots of other things they do. Just to briefly, how does a good advisor add value?
So, I would say exactly what you've just mentioned. So it's about taking somebody's entire financial landscape and planning it for the long term. I remember that there's a great image I've seen drawn on the wall of one of our advisors, which shows the ideal of a financial plan as being a straight line from A to B upwards. But in actual fact, over that line, there's a very up and down, topsy-turvy approach that actually through somebody's life, they go through several key moments, milestones, things happen that are unpredictable, financial situations change, and actually having somebody there the entire time is what adds value. To take them off the highs, to bring them up from the lows, to holistically look at their tax situation, plan legacy for the children, and help them achieve their goals. I think another term I like to use is goals-based financial planning. What is it you want to achieve, and how can investments facilitate that? It's the engine room, if you like, for that journey. But in actual fact, it's not about just growing your wealth or becoming wealthier. It's actually about creating enough wealth within a risk appetite to do what you want to do in life. And financial planners act as that coach, that companion on that journey.
Guys, this has been a really interesting discussion. I'd just like to wrap it up now by asking you for one final tip that you can hand over to investors. Laurentius, if there's just one piece of advice that you could give investors, what would?
Robin, me and James have got a joke going on where we usually say, wine is for drinking. You actually get wine funds. Don't invest in it. Wine is for drinking. Property is to live in. Cryptocurrencies is for nefarious activities. Equities and bonds is actually for investing. Stick to what has worked in the past. Like I've said, the reason why something like our timeline tracker has performed well in the past and has been the top performing MPS solution in the UK over the last 3 years is in fact not because we've got a great investment team. It's because we've stick to our guns. We've invested in what actually worked historically. At the end of the day, we are trying to avoid stupidity. That's what we are trying to do.
James?
Yeah, I'm going to start off with a warning and then I'll move to my tip. So I think on Laurentius's cryptocurrency point earlier, there's a real surge I've noticed in this idea of the meme coin, which is this idea that a celebrity sells a version or a cryptocurrency that they create themselves, curate and sell as a wealth generation tool. And I'm seeing more and more young people getting drawn in the idea of, well, I like them as a person, so that must be a good thing to invest in. And I can't stress how stupid and dangerous that is. These systems are created to pump and dump, so they create a lot of sentiment for the person to make their own personal wealth, and when they feel it hits a level, they dump out of it. They collect the wealth, they leave everybody invested with nothing. And so my warning there is do not buy anything from anybody you think is a celebrity. And my tip would be invest your first £100. Get over that barrier. Open an account, open a simple ISA, GIA, pick the most low-cost, simple fund you can find and invest your first £100 and let it sit there and feel comfortable with it. And once you get yourself over that hurdle and you can see how it works, you can go through the first emotional steps of seeing it go up and down, then you'll start to feel more comfortable contributing more amounts and more regularly over the long term. And I think it's the daunting idea of that first step that people should get over, and then that will help them long term with their investments.
That's really good advice. Just get started. Right. Because the earlier you start, the better. Guys, it's been a really useful conversation. Thank you very much for your time.
Thank you very much, Robin.
Cheers.
And there you have it. Evidence-based investing and how to go about it in a nutshell. Remember, investing involves risks and commitments, and it's vital that you understand what those risks and commitments are. Bear in mind too that although there are a few simple rules that apply to everyone, all of us have different needs and circumstances and attitudes to risk. If you're in any doubt about what to do, seek professional advice before making major decisions. You've been watching The Investing Show, brought to you by Timeline. Please do share this video if you found it helpful, and why not subscribe to our YouTube channel. Thank you, as always, to our guests, and especially to you, our viewers and listeners. Until next time, goodbye.